Hi, this is Skyler with Regan Capital. Today, we're going to look again at the TBA market and talk about some anomalies we found in how prepayment speeds are generated, especially something called consensus prepayment speeds. So, first of all, let's start off with the US Ag. And on Bloomberg here, I use this tool called WBIX, World Bond Indices, and this lists most of the major indices out there. And we'll start with the US aggregate. You can see here it's up about 13 basis points for the year. So I flip over to that and we look at this is the biggest bond index in the world. It's roughly $31 trillion. You can see the market value at about 28 trillion, duration at about six. Well, let's focus on the first the six largest components of the ag. And these are all market weighted indices. So the largest bond issuances out there are going to dominate these market weighted indices. Okay. And we see here you have Fannie and Ginnie 2 and 2.5% coupons. Um, I'm going to look at the same thing in the mortgage backed index, which is an $8 trillion index. And you'll see here it's also dominated by these very low coupon bonds. Okay. So let's look at the data first of all. And you could see that here on this is all outstanding Fannie Mae issuances by coupon. And you can see the amount out that was originated and the amount that's currently outstanding. And the market is dominated by this 2 and 2.5% coupon bond. So in total, I put these all in a spreadsheet. In total, and I only list, I don't list the off coupons like 1.75, but I list the major ones, 2 up to 7. You're looking at $5.1 trillion in outstanding securities. And you can see here it's dominated by these coupons that were originated primarily in 2020 and 2021. These underlying borrowers are paying high twos to high threes, and the bonds that got issued were 2 to 3% coupons. I call these index bonds because they are what dominate the index. And if you look back to that mortgage-backed index, you can see here there are some newer issues in here. There's 5.5s, 6s. Here's a 5.5 right here, because those are decent sized positions within what's outstanding out there. But again, if you're investing in a mortgage bond index, if you're investing in the ag, those products are going to be dominated by these very low coupon bonds. And you can see here yields are the lowest, spreads are the lowest on those particular bonds. Also, dollar price is very, very low. So you're getting a very low dollar, long duration, lower yielding security relative to what you could get by buying new issue. But let's delve into the biggest bond in the market, which is these Fannie 2s. Okay. Let's pull up what that is. So you have these loans that are about 3 years old because they were issued in 2020, 2021. The underlying borrowers are paying a 2.94% coupon. And I'm going to pull up yield table to do some analysis on this. Okay. So this is called PSA. And this is the prepayment estimate. I'm going to multiply that times roughly 6. Okay. So 4.8 CPR gets me, what does that mean? 4.8 CPR is estimating that 4.8% of these borrowers are going to prepay annually over the next 27 years. Okay. So PSA is a ramp, and after 30 months, it gets to roughly 100 PSA, which is the equivalent of 6 CPR. 200 PSA is 12 CPR, et cetera. And so for each coupon, the market is putting a different prepayment assumption on it. So these very low coupons are assigned 80, 90 PSA. That's only 4 to 6 CPR. As you get higher in coupon, where the borrowers are making higher coupon payments, these borrowers or the market is now estimating 6, 8, 12, upwards. If the underlying borrowers are paying an 8% coupon, the market's estimating that these will eventually get to almost a 30 CPR, 30% annualized prepayment rate. So what goes into that, and how does how do these assumptions affect the bond? So you could see here, base case, this is about a 5.25% yield, and this is market pricing today, about 60 spread over a 7-year duration. Okay, let's double that to 10 CPR. Let's do 15. Let's do 20. Let's do 25, and let's do 0. Okay, so this is kind of viewed as your downside. I don't think that would ever happen. You could see up here what this bond's actually paying. It's paying about 3.5 to 4% per year. You can see the market's estimating for it to pay a little bit higher than that, but that's over its life. That's over the next 27 years. Okay, so uh, 0 CPR would imply nobody ever gets divorced, dies, job relocates, you name it. That's not possible. We're sitting at the lowest prepayment rates we've ever seen in history at 3 or 4% a year. Okay. So realistically, maybe this goes to 3. And you go from a 5.25 yield to a 4.82 yield. You extend from a 7-year bond to roughly an 8.4-year bond. And they call this bond extension. Okay. And back when they originated these 3 years ago, the market was assuming these were going to prepay at a rate of about 20% per year. So this was a 3-year bond. It was issued at par, roughly, and it extended to a 7-year bond. So, and now it's trading at $77. So this is what hurt Silicon Valley Bank. Government's the largest owner of these. Kind of a big deal. But let's take a step back and figure out, well, who's actually inputting? Where do these inputs come from? This is called consensus prepayment speeds. So consensus to me implies a large number of inputs to arrive at a consensus. How many banks, and what's going on here behind the scenes is there are theoretically multiple investment banks that are creating these assumptions and updating them regularly as rates change and as the market changes, as mortgage rates relative to interest rates change. Okay. So when we delve into who the consensus is, okay, you have all these banks listed over here. All of these banks over here are supposed to be theoretically putting out what their assumptions are. But in reality, there's one bank, JP Morgan Securities. Up here, this is BAM, and you can read that little text there. This is the Bloomberg median calculation. This is actually a Bloomberg input. It's a model. And if you read that there, it only was added to this estimate about 4.5 years ago, August 10th of 2020. So you only have one inputter who is basically ruling this entire market. Okay. And this is again, a $1.4 trillion market where the US government's the largest holder. United States banks are very large owners of these, as well as large index funds like a Vanguard, a BlackRock, a Fidelity that run these large total return funds, large mortgage-backed funds. Okay. So has this always been the case? Okay. Let's go back a year. There's only one inputter, and that's crazy. So remember, so you had today, Bloomberg median speed down here 79. So Bloomberg's actually using their own model as one of these inputs. And then they're using JP Morgan Securities as one of the inputs. And you could look at these two. They're actually using the average, not the median. Because if there's only one or two instances, the median doesn't really make any sense. So you have 83 or 79 as you see today. Let's go back a year ago. No change. So even though, and let's look at where rates were a year ago. You have a rate movement from, and let's look at this live. So a year ago, the 10-year rate was at 410. Today, the 10-year is at 465, but you have absolutely no movement in estimated speeds. About 2 years ago. Oh, we have a new entrant, Credit Suisse. Credit Suisse doesn't exist anymore. They basically dissolved and or were acquired by Athene, which they renamed it Atlas. But a very minute move. We went from 80 to 86 in median. These guys didn't change much. Let's look at where we were in 23. In 23, the 10-year was at 360. Today it's at 445. How about 3 years ago? Okay. So now we're looking at when we had a larger constituent base. Okay. We had Credit Suisse, JP Morgan, Bank of America, and Barclays. So you actually had four entrants here that were all submitting. And all of these over here is okay, well, is my speed going to be if rates go up 50, 100? What if rates go down? You could see here rates at that point went from where they were 2022. Rates were at 128. And so there's actually an estimate. Well, what if 10s go, and that's 3 years, sorry. Rates were at 175. Today they're at 465. So about a 300 basis point move. So you could see here, if you went from this 177, 176 down to 76 basis points, a very large move there. So that's why market participants are really keen on, okay, what happens if rates go down or up? A lot of banks in their regulatory reporting that they're submitting to the FDIC, the Fed, et cetera, they have to do all these changes and they have to show the regulators what's going to happen to their portfolio. Okay. And back then, if we look at, where we were when the Fed, right before they started cutting interest rates, I think they started cutting in March of 2022. Back then, it was totally unreasonable to run a plus 300. No one was really doing that. So they were more concerned about, credit quality. So I own this Fannie Mae paper. And let's just go back 4 years, and this is the last thing, because we're going to see something, really wasn't that much different. You did have much higher prepayment speeds. Where were rates January 21? They were roughly at like 1%. Okay. So when these banks were buying these securities, which was 2020, 2021, they were buying into these, assuming these were going to prepay at a rate of about 18 CPR. Okay. But fast forward today, you have one of the largest markets in the world where there's only one bank that's actually submitting this. And when we think about that, and I'll pull up the current coupon issuance, and current coupon refers to the bond that's trading closest to par, and that is this Fannie 6 right here. So let's pull up Fannie 6s. There must be a ton of banks that are submitting this because this is the current coupon bond. And the market's estimating that roughly about 15% of these borrowers are going to prepay per year, about a 4-year bond. Even though these borrowers are paying 7, I'll take the over on that. So I can pull up who's submitting on this, and it's only two banks. It's JP Morgan and Bank of America. Long story short, you have these very large markets that the U.S. government owns, major players in the financial market own, where there are very few inputs to determine one of the key variables out there, which is, okay, what are these borrowers going to prepay at? So if we look at these Fannie 6s, let's look at and say, well, what if rates go up 100 or 200 and instead of 15 CPR, it's 5 CPR? Okay. Which is kind of what we saw a couple of years ago. You saw extension. That's one of the major risks of owning this par bond, even though it's almost a 6% coupon. You're worried about, well, what if it goes from a 4-year bond to a 7-year bond? That's always really been the rub on mortgage backs. Okay. But on the flip side, what if I invested that money and hoped that I would be getting 6% or 5.90 for the next 4 years, but instead rates drop 1.5 points and I only get a 2-year bond? Okay. So your yield's not going to change much, but that's going to change a lot. So the way we look at this, and the thing that we saw, and we asked Bloomberg, who brings these in, we're like, what's going on? And they basically said that, hey, look, we ask these banks daily, if not weekly, to submit these projections. And now we're down to one, maybe only two banks in these huge markets that are submitting these. So what this opens a can of worms of is, look, what if you had this minor change at the end of a quarter, end of a year, where instead of submitting 15 CPR, they submit 13. And if they were to do that, yields would go up, their portfolio would extend, vice versa. If they submitted a faster projection, maybe they want to shorten their portfolio. And that's going to affect banks, particularly the federal government, which has lost, upwards of almost $1 trillion on their investment in mortgage backs. It's going to affect very large players out there only having one, maybe two submitters. And so it's kind of buyer beware when you're looking at these and you're relying on that consensus prepayment speed. You have to develop your own models, your own thought process around what's my upside, what's my downside when it comes to both yield and duration on these securities. Thank you for your time.